When the markets go up, our portfolio will also rise. However, when it declines and then recovers, the same portfolio may not perform as expected. So this raises a very important question. Which shares should be adjusted? What is the right decision? Should the portfolio remain unchanged? If there's new money, where should it be invested? Are mutual funds a better option than individual stocks? Should derivatives like F&O be included? These are some common concerns in any market environment. There may be several such doubts, questions, or opinions in your head. Just reach out to us on Ask Me Anything, and you can ask us anything and we will help you. Reach out to us today.
Hello, welcome all. Today we are continuing with our series Talking Straight with Shyam Sekhar. We are going to continue our discussion on Solitaire and how we have been constructing and building portfolios under this investment philosophy. So let's start this conversation with Mr. Shyam with us here. So what shaped the core philosophy of Solitaire?
In my experience, I have seen that the investing that I do for myself need not necessarily suit another person. I learned this while I invested for family, while I helped friends. And in that process, I realized that whenever I invest for others, I should basically create a product which will suit them, and it should not be about me. So my thought process for a very long time, maybe 10 or 15 years, was thinking, what is it that can suit a whole lot of people? For all people who have careers, who want to invest to create wealth out of their savings, and who want to have a much better experience than what they currently get. There are a number of products which people invest in, which give them returns, which also give them anxiety.
Correct.
So I was always looking at how can I make this experience better. And that thought process led to a certain philosophy which would adhere to certain investment principles and rules. And based on those principles, curate portfolios.
Understood.
So I created one portfolio and ran it for a period of 10 years. It is that concept which I converted into Solitaire. I just branded it as Solitaire.
Okay.
And I say converted, there's no change. It's the same thing. And I think the most important aspect of Solitaire is that from the day I originally thought about creating a product like that to this day, we have stuck to the principles. We have not changed because our need to invest grew from, let's say, a few crores to a few hundred crores to now over 1,000 crores. So the principles have held on very well, and we have been able to execute the same way. And scale has been something which we have managed to handle very responsibly and sensibly. So it's something which I thought about very early to help my friends and family own shares peacefully and not necessarily go through what I am willing to go through as an investor. The uncertainty, the wait, the drawdowns. So that thought process of creating something which will suit others is the core of Solitaire, and the principles hold it together quite well. So that is where it all started, and that is what is working.
Okay. So when you talk about the philosophy, right, focus is on bottom up and non-consensus investing, if I'm right. So, and also it follows a buy and hold approach, right? So how do you strike a balance between sticking to your convictions and also staying agile when opportunities show up?
See, if you notice, we don't trade too much this product, first point. Yet we try to bring in themes and businesses which are, kind of very, very important and relevant to the economy, to the way people experience prosperity. So we think through it for a long time. The first point is we think through it for a long time. we ask ourselves what is the valuation at which if we buy, we can hold it for an extended period of time and still make those returns. Why do people keep changing their portfolio stocks? Because they think that they have made this return over a period of, let's say, 1 year, and then in the next 1 year they won't make the same return, which they could seek elsewhere. Now, suppose you buy the stock at a valuation which is very, very low, you may make 2 years return in 1 year. And even if you don't make return for 1 year and it time corrects, it's not bothering you. So, it's very, very important that you think through an idea for a very long period of time, build the conviction, and then translate that conviction into a decision and ensure that the decision gets executed at a valuation which helps you to own that stock comfortably for a longer duration of time. When you own it for a longer duration of time and you also get the benefits of compounding without having the need to churn, then your buy and hold strategy is actually working on the ground, right?
Correct.
And whatever exploratory themes or new thinking that you're trying to bring into the portfolio is also constantly going through this process of validation, which follows ideation. So ideation, then validation, then you ask yourself what is the valuation that you're comfortable with, and then you go to decision, right? So this, it takes time. There is a gestation before you buy anything. It's not as if you wake up one morning to some newspaper article which gives bad news and then you go to the market at 9:15 and say that I'm going to buy this stock in my portfolio. That never happens. It can happen only if you have completed the research in that stock completely and I have the report which has already been done and reviewed by me, and I can call the analyst and say, in the wake of the new information that we have, do we have to see this differently or do we continue with our conviction? And once we get that, we are ready to go. So you must be in a state of preparedness in all the ideas or themes where you want to invest, and an event should just be an opportunity that is thrown at you.
Understood.
So that is how all these
Buy and hold.
that is how you can bring a opportunity seeking approach
Correct.
into a buy and hold strategy. You can't be waking up one morning and suddenly making a decision and buying a stock which you will buy and hold for 3-4 years. I don't believe in that.
Got it.
It's very, very rare to get such opportunities. So the opportunities that you actually get happen to you because you are already in a state of preparedness with research and with validation, and you are only waiting for the decision.
Got it. So one more key pillar, I think, of Solitaire is risk management. So what does that look like in practice when you are constructing the portfolio?
See, one thing about Solitaire is that even at the peak of our, aggressive buying, which is in the early part of Solitaire, the first 6 months, we did not buy any single stock over 7% position sizing at cost. Progressively, it has actually come down. We don't cross, let's say, a 5% position. It's not that we don't have conviction. It's just that our discipline with valuation doesn't allow us to buy too much, because we would want to buy on last 1 or 2% where the valuation is far more attractive and in our favor, and generally the stock doesn't reach that level, right? So there is a very rehearsed approach to position sizing. Even in the beginning, we had a very, very cautious approach to position sizing. I had an approach where I used to follow a framework where I used to do my position sizing in 3 slabs. Okay. 3%, 5%, 7%. So as the conviction rises in my mind, I would raise the position. This is how I used to do it in my personal portfolio before I did professional work. But when I came to professional work, I decided that I will start buying only when I have the conviction to buy a 7% position at 3% itself. So at that point itself, I want that conviction. And if the market misprices the stock, I'll add a little more and take it to 5%. And if the market further misprices the stock and my conviction is also rising with no change in my basic belief in the idea and the hypothesis, then I can use the irrationality of the market to further go up to 7%. So the same framework where I followed an exploratory approach to ideation and validation, I am doing now with a clear thinking that I will complete my ideation and validation and then only start the position. And then the position sizing is a function of what the market lets me do. If the market lets me do more, I'll do it. Otherwise, I'll stop myself. So there is a certain rehearsed approach in this, and I think it's working very well, especially when you are having to invest more money for more people. Because it's very important that you give a very harmonious investment experience for everyone. You can't give a great experience for one set of people and a not so great experience for another set of people.
Correct.
So your process has to support everybody equally.
Correct.
And I think that this method of actually coming to a conclusion on the ideation and validation and then starting the position is helping us to do it with a greater degree of control and confidence, and we get more conviction when the price falls.
Correct.
And we are not looking for answers after we have started investing. We are looking for opportunities after we start investing. The answers should all be taken into account before we start the position. So there is a certain orientation to decision making and to the process itself, which I think we have brought into this, which differentiates what we do. And it gives us more power to do better, and it gives us more control over the process.
Now, from this risk management framework, I think it's visible in the portfolio. Almost 75%, more than 75% of the companies are debt free. Now, how do you view leverage while you are filtering stocks for your portfolio?
Again, this is a very strong view, I would say, but most investment products actually carry leverage inside the portfolio. For example, Nifty has 40% financials, which is
Correct.
principally leverage companies.
Yes.
Over and above that, you have other cyclicals in which you leverage. So if you are an index investor, the leverage in your portfolio is quite high. No one realizes that. My view is that the average investor in India who is trying to build wealth for himself doesn't even have that risk appetite. He has a lower risk appetite. So you should actually invest in that part of the market where this leverage is not there. So actually, if you are investing large cap, it will mostly be within the Nifty.
Correct.
Let's say you are investing large cap in Solitaire, it will be within the Nifty. Even in that, it will be away from the leveraged part of Nifty, which means that those leveraged companies are not part of your universe. So you have to build a large cap portfolio outside of those stocks.
Correct.
Largely. One or two we may buy companies if, let's say, they have an NBFC, which I think they are going to get out of, or a financial business, which I think they will not stay. But the core business is without leverage. So that's a rare exception we make. But largely, I don't even want that. I mean, I would ideally want that company to give away the leverage part of the business, and I would like to only invest in businesses without leverage. And by doing that, I am reducing the portfolio risk significantly. And if I do this with a very strong control over valuation, I'm sure the investor experience will be superior over a long period of time. Investors will be very comfortable. If you look at how investors are comfortable today with mutual fund products, you take the products where they are having comfort, you will see these traits. These traits which I am saying, that they don't own much of leverage companies, you will see that, yeah, they may hold on Kotak Bank and on HDFC Bank. But outside of that, it's not a leverage heavy portfolio, right? The rest of the portfolio is actually trying to make amends for that.
Correct.
Right? I am trying to do the same thing even without these banks. I am trying to do that in such a way that there is very little leverage in the portfolio. And also, see, when you buy a portfolio of companies without leverage or with very little leverage, when they do well, the entire benefit goes straight to the shareholder.
Correct.
You don't have a line item called interest.
Correct.
So more growth, more shareholder value gets created. It's very simple.
Correct.
And the ability to pay out more money is also there, right? If you have loan, you have to pay the loan, and whatever remains only you can pay as a dividend.
Correct.
So all these aspects are things which I feel you should embed in your portfolio philosophy or your investment philosophy. And when you embed it and you stick to it, I think the benefits are much better.
So there is a fair bit of exposure to small and mid also in our portfolio. How do you ensure quality and also scalability, especially in this small and mid segments?
That's a difficult part because you have seen valuations always high. Generally, what I do is I look at companies which are not new to the market. Market is tired of very many companies. Market will be seeing many companies in time correction, which have done well in past cycles. I look for those companies. So the valuations are moderating and liquidity is high. Institutions don't want to invest in them. Institutions who invested in them in the past cycle want to get out of them now and put that money in something else which they think will catch the market fancy. So this out of favor businesses is a catchment. And you have to look very closely to see whether the fundamentals of the business is improving, whether they are going to grow faster, whether they are going to see higher capacity utilization, more efficiency, better capital efficiency, higher return metrics. When you see many of these boxes getting ticked, then if the valuation is right, you go into a smaller company, right? So it's bottom up, it's away from consensus, and it is very valuation driven. So these three things ensure that you do find ideas even in small and mid cap, and you are not going to be overpaying. So it's a little tricky, but if you have discipline, then you learn to maneuver this.
Thank you for joining us for this insightful session on Solitaire's journey and its investment philosophy. Keep watching in for the next episode, and we continue this discussion with Shyam Sekhar on Solitaire's investment philosophy on Talking Straight with Shyam Sekhar. Thank you.